So acquisition of control in the tax realm is a complicated area, and so I want to make sure we get off to the right start by understanding exactly what it is before we even get to the tax implications. What is it that we're talking about? So acquisition, what we mean is buy new shareholders. Okay, so what we're talking about is a corporation that's existing already is now going to be acquired by new shareholders. So, I mean, implied here, of course, is from old shareholders, right? Okay, so that's the first thing to note. The second thing to note is that this idea of control of what? So for the most part, let's just skip across here. So control is of the corporation. So in our world, what we mean there is of a taxpayer. So a corporation is being acquired, the control of, a corporation is being acquired by new shareholders. And what this usually comes down to is voting rights. So in our world, we'll just say if it's greater than 50% of the voting shares, then we will assume that the person who has acquired that amount has acquired control of the corporation. Okay, so very important to understand that what we're talking about here is if our taxpayer, if the company that we are accounting for is owned by one person, Mr. A here, so this is an individual who owns 100% of the voting shares of A Co. The transaction that is triggering, so what we've been doing this entire course, what we've been doing is we've been doing the tax for A Co, right? Our taxpayer is A Co. Important, very, very important to understand here that this transaction is going to happen. Let's make this a Ms. B. So Ms. B is going to come in, and these two people are going to transact, and shares are going to go, so these shares here are going to come over here, and she is now going to own 100%. But when we look at this from our point of view, from the tax reporting point of view, what has happened in here? Nothing. Right? Nothing has happened. There has been no transaction that is taxable going on here. Right? We're used to saying ACO transacts with, ACO sells something, ACO earns revenue, ACO earns income. Now we've got a transaction going on between the shareholders of ACO and an outside party, which will become the new controlling shareholders of ACO, and that is triggering this huge taxable event that we now have to understand how to account for. But please understand that we're in a very different place here now, where it's not simply the income, the revenue and expenses that are being generated and spent by this company that is triggering this. This is an outside event that has to do with the ownership of it. So once we understand this is a transaction by the shareholders that is triggering this thing, we think, okay, well, why is that? And really what it is that we have this problem that we started to encounter with the integration between the personal and the corporate tax realms, and we've got an intersection of them here now, where basically we've got these fictions, these legal fictions that we call corporations, and when they change hands, it could be that tax benefits and costs that have been imposed or extended to these corporations, we don't necessarily want to transfer to the new owners, because most of the things that we have in place are sort of incentives for companies to do things. But again, I want to reinforce that more than likely, in a lot of cases, ACO has the same managers, same employees, same transactions, same customers as it did the day before it was acquired as it does the day after it's acquired. So what happens? What does the Income Tax Act do? It says, well, what we really want to do is we want to have this be a point of real break We want there to be a definite time or definite demarcation between the old owners controlling it and the new owners controlling it. And so what they do, and I've actually got this here in your textbook, there's a very helpful checklist on page 656, so I've just put it here. Not that we will refer to it, but I just put it there so that you would know to look in your textbook, because this is one of those things where you're just going to have to get a sense of what happens. And so we'll use that. The first one there, and I've also got highlighted here just so you know, there are some really good examples in that gray, in those gray boxes in that section. That will help you with some of the mechanics of this. We'll also do it in class, of course, but it's not entirely intuitive until you do a few of them. So what happens? They have this idea of a deemed year end. So if you're in my sections, again, the queen is taking out her sword and is tapping it on the shoulders of this corporation and saying, I deem you to have a year end. So normally, you know, if we have a timeline, we have a year end. So if it's 12/31, so we have a year end on 12/31, 09, 12/31/10, 12/31/11. It's coming, etc. 12/31/12. Well, if there's an acquisition of control at any point, so let's just put it right here, then boom, there's a new year end, and everything happens that would normally happen at a year end. And that is, so this is the deemed year end, and we have to file a tax return. Okay, and not only do we have to file a tax return, so for whatever that period is, from the beginning of this year here through to here, we've got, it should be a different color, we've got a tax return being filed. Okay, and so, you know, CCA gets prorated because there's not 365 days in the year, etc. All of those things happen. Very complicated exercise, but made even more complicated by the fact that why they have this whole deemed year end in the first place is this idea of we don't want a whole lot transferring from the existing controlling shareholders to the new controlling shareholders. So what are the things that they do, that they impose here? Well, first of all, they say that we are going to expire basically everything. So net capital losses carry forward, gone. Allow business investment losses that you have existing, gone. Property losses, gone. Donations that you have not yet been able to deduct under Division C, or have not yet deducted under Division C, gone. Okay, so whereas we've just talked about last class with Division C saying, okay, we have these things available for carry forward until, so, you know, net capital losses carry forever, right? We said this. We said indefinite. Well, indefinite becomes very definite, and very definitely zero after you have a deemed year end, or when you have a deemed year end. Okay, so that's the first major consequence that we're going to have to deal a lot with. The second one is that your assets are valued at the deemed year end. So I'm going to shorten this down to DYE, at the deemed year end, and accrued losses are, so essentially you're deemed to dispose of these things and realize these losses. So you're deemed, really the way it's put is, we deem that you have realized the losses. Okay, so the queen gets out her sword again and finds these losses and deems them to have actually been incurred, which basically means you're going to have either a bunch of capital losses, depending on the nature of the property. You're going to have capital losses, or you're going to have terminal losses, and they're going to either decrease the income that you have this year, or they're going to increase losses, and we'll talk about that. And then the third major thing is that the non-capital losses, so you note that the non-capital, they're not here. They don't expire. You get to carry them forward. So non-capital losses, you do get to carry them forward. But the use, so the non-capital losses carried forward use is restricted. And how is it restricted? In a nutshell, it says, you can't just use this to offset any income in the future. As we learned last time, non-capital losses are applicable against any kind of income. Not so anymore. These non-capital losses that arose before the acquisition of control, they can only be used to offset income, or maybe better to say only deducted away from income that is from the same or similar business. Same or similar. Okay, so this causes lots of fun and games that we'll talk about, but basically what they're saying here is, they'd love it for it to be same. They're saying, fine, you acquire control of this thing, but unless you run that company and turn it around and make it profitable, if you make it profitable, then by all means we'll let you deduct those losses that were there when you bought it. But if you just bring it in or if you just acquire this thing and try to use it to deduct those losses from income of some other business that's very profitable, we're going to disallow that. So this seems a bit, it's punishing almost, right? When you look at what's going to happen, we're going to lose all of our loss carry forwards, and we're going to have our losses, if we have accrued losses or unrealized losses on assets, those are also going to be added to the pool. And when you look at these and you think, okay, well, what's in here? What's in these assets that could be valued? Well, think about something that's non-depreciable. So our favorite non-depreciable asset, land, right? If I have a capital loss, right, so that if I have a loss on it, it's a capital loss. Well, if I have a capital loss on that, this step 2 is going to deem that loss to be realized this year. So basically say, here you go, you've got a capital loss, take half of it, an allowable capital loss. And then step 1 is going to say, and by the way, you can't apply it. It's gone after today. So going forward into next year, on day 1 of next year, your net capital loss carry forward will be 0. So whatever we're deeming you to have realized right now is going to be 0. And so there is, to avoid this, there's sort of this get out of jail card possibly offered. And what it is an election. So we're given, but the word election is, I think we've met it and we know what it means. It means it's up to you whether you want to do this. And basically what it's going to let us do in a nutshell is say, okay, in order to deal with, to help offset some of the sting of this sort of 1-2 punch, we are going to let you deem, so that you get to do the deeming this time. If you make the election, well, I guess they actually do the deeming, so you don't get to hold the sword, but you get to say, please use the sword and deem this. So deemed disposition of these assets. So I'm just going to shorten this: depreciable or non-depreciable property. So we know that we can't have capital losses arising. So this capital losses can only arise from the non-depreciable. But what we're saying is here, you can deem disposition on your depreciable or, this is an or, not an on, or non-depreciable property that has with accrued gains. Okay, so if you have some assets, so what the first steps up here did was say, if you've got assets that have accrued losses on them, you have to realize those. Down here are the ones that have accrued gains. So we're not going to deem those to be realized without this election. They will not be deemed realized, and so you won't pay tax on those gains. But you might want to do that. Why would I ever want to do that? Why would I ever want to increase my income? Well, it's because we want to create the gain. So we want to create a gain to offset, or income actually, because if we have recapture on these things, income to absorb losses that are either going to expire or that are going to be hard to use because of step 3. So if we know sort of the future, if we say, listen, we're not going to be able to use these losses, let's absorb as many of them as we can now, and because we're just not going to get, this is our last kick at that can. So let me make sure I get this down. Create gain or income to absorb losses that will expire. Okay, so how does this all work? Well, there's actually, I mean, it's not that difficult. So we'll pretend there's only one way to do it first, and that's what we call the maximum election. And so basically how this works is you can choose deemed proceeds of disposition for each asset, and the range is range is the ACB of the asset up to the fair market value of the asset. So you can't go above what you actually could sell it for, because remember, this is deeming. You are not actually going to sell this thing. You're going to be deemed to have disposed it, and then the corporation will be deemed to have reacquired it the next day. Okay, but the only restrictions on this then are you do it on an asset, not on an asset that has an inherent terminal loss. So that's obviously a depreciable asset, but you can't do it on there, and you cannot do it, and you can, but it is okay to do it on an asset with recapture. So again, as I mentioned, why would we ever want recapture? Well, it's just actually this will come out more clearly when we look at the partial election. So okay on an asset with recapture. Okay, so those are the two little caveats, but other than that, you can basically go asset by asset and say, okay, there's a gain on that, let's deem it to be realized or not. So this election that we looked at, we usually refer to as the maximum election. So essentially you are going to trigger, I guess it's so named because of the maximum gain, but the potential anyway to trigger the maximum gain. The other election that is available we refer to as the partial election. So this is complete choice, right? So it comes down to the taxpayer, the corporation, making the choice of which they want and which election they want to file. Okay, and so that will come down to situation, and we'll look at it in the problems. Like how do you make that decision? Similar to a lot of the other things we've been talking about, it will be situation by situation based on the losses that they have, the income that they expect, etc. But in a partial election, so really the main point of this is that this lets you preserve business losses. Okay, so why would you want to do this? Well, this is basically if you think you can use them, if they will be usable in the future, and this comes back to the whole thing that you talked about at the beginning. I'll just scroll back up there. This third one, this restriction on the losses. If you think this same or a similar business that you will be under the new ownership, the new control, will be able to use these losses, then you may not want to trigger recapture this year. You may prefer to carry forward the larger losses, because each of these things, and we'll see this in the problems, but each of these things kind of comes with a little bit of extra baggage in that the maximum election, the cost base of your assets can be increased, whereas with the partial election, the cost base of your assets is not increased, at least as much, and so you have less. You'll have more gain in the future, and so lots of trade-offs. But let's try to keep this a little bit simple for now. Preserve the business losses is the main point. And what this says is, instead of looking asset by asset, what we do is we say the proceeds of disposition will be 2 times the sum of a bunch of things, and this 2 is just 1 over the capital gains inclusion rate. Okay, so this is, it's 2 right now because the inclusion rate is a half, but that's what that is. And so this will be the allowable capital losses in the current year, meaning the deemed year end, so deemed year. So in the current year that will expire. Okay, so that's the first piece, plus the net capital losses. I don't know why I used an acronym for one and not the other, and why I'm writing so many S's. Net capital losses that are expiring. So if you had them carried forward, if they are going to go away, this is, and again, what we're coming up here with is the proceeds, so which is a bit confusing, but we'll show you why it should work, and the property losses and ables that are expiring. So what this is doing is saying, and I'll just scroll back up, oh, and we want to add one more piece. So it's 2 times all of that plus the adjusted cost base of whatever properties, assets we'll call it, included assets, meaning whatever assets you are intending to make this election on, the adjusted cost base of those gets added. So what we're doing is we're coming up with the maximum proceeds of disposition for the entire pool of assets will be equal to this. And so when you look at this thing, it has 3 pieces, right? It has the allowable capital losses, has that, really it has 4 pieces because the property and then the ables 4. Well, those correspond to what you are losing up here, right? You're losing net capital losses, ables, properties, nothing to help you with your donations. But that is what we are essentially, that's what's happening. We are saying you can have proceeds up to that point. And so if you are electing correctly, then what you should have is you should have all of these things that are about to expire should be wiped out, if assuming you have enough gains, and that's why this is here. If you have enough inherent gains, I mean, the gains have to be available, right? We can't just create income to wipe out these losses. You actually have to possess assets that have inherent gains. But if you do, then, and you make this election, then what you'll be left with is more non-capital loss carry forwards, but you will have used up losses that would have otherwise expired, and therefore will reduce gains that you would otherwise have to report in the future. Okay, I hope that's clear, because basically, okay, I hope that's clear. And the next video will be a walkthrough of a problem, which in this case I think helps a lot more with understanding.